Time to exit stocks. Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Peter Boockvar, Chief Investment Officer at Bleakley Financial Group. Hi, Peter. It's great to see you.
Great to see you as well.
So we certainly seem like we're living in the Santa Claus rally. Stocks have continued to put in unbelievable performance, taking pauses now and again, though, as we kind of extend this. But economic data is coming back into focus, it seems, this week. We have jobs data out, ADP, the private payroll number coming out. We've got a big government number on Friday. How are you feeling about the economy here?
So I still see an economy that's really mixed. The headline GDP number is still very good, around 2.5 to 3%. But if you look under the hood, there are a lot of cross currents and I've been referring to the economy as sort of a two-lane highway. In the fast lane is higher income spending, those that are benefiting from the wealth effect of higher stock prices, higher home prices, and still a labor market that's pretty good. And they're particularly allocating that spend on travel and leisure and going out for dinner and that sort of stuff. And then you also have anything related to any beneficiaries of all the AI spend. Marvell Technology, the new chip company that's selling into that end market, and they reported a good quarter with the upside coming from there as opposed to other places. And then you have, of course, government spending with budget deficit relative to GDP of 6% and call it $2 trillion a year. And a lot of that, excess money going into healthcare, the CHIPS Act, the Inflation Reduction Act, infrastructure, and all the economic lift that brings. And also on the labor market, the pace of firing still remains pretty muted as seen with jobless claims. In the slow lane is low to middle income spending. As we speak, Foot Locker is down 20% this morning, talking about a very cautious, circumspect consumer, and that are really more focused on timing their shopping around holidays, not in between, focused on value, convenience, and there's just certainly a reining in for the reasons we all know, and that's, of course, the cumulative rise in inflation that has been so dramatic over the past 4 years. Also in that slow lane, we have manufacturing that's in a recession, global trade that's pretty muted. We have the pace of existing home sales near 30-year lows.
Mm.
And when there's not a home that's transacted, there's less stuff to buy in terms of renovations and that move-in. So that's not really taking place. And on capital spending, everything outside of AI is pretty muted as well. If you look at the semiconductor space, Microchip Technology on Monday lowered guidance. They don't have big business in AI. They have more of an industrial use customer, and they lowered guidance. And then if you look at core durable goods, which is non-defense capital goods ex aircraft, it's basically flatlined for the last couple of years. And then with the labor market, the pace of hirings has definitely slowed relative to the pace of last year. So all in, the headline numbers seem good, and some people say, oh yeah, the economy's great, but you really got to look underneath and really slice and dice and realize that it's very mixed. And it's also mixed globally. You look at Europe right now, Germany, France, Italy, basically contracting if you look at their PMIs, but then Spain is the bright spot there. You look at Asia, we've seen obviously a deceleration in growth in China because of the stress in the residential real estate market, but India is growing 7%. It's important to really get more detailed and granular on where the strength and the weakness is taking place in not only the U.S. economy, but globally.
Yeah, as you say that, that's kind of the argument for active management, right? You can't just pick a sector or, sort of whack it into something because you need to know which one of those lanes they're operating in, right? It makes it kind of tough to broadly pick something.
Right. There are times when sort of passive, just broad investing works, and it has worked for years now. But maybe we're entering a situation where the market becomes a little more discriminating. Now that said, though, since July, and I'll specify why July. Since July, the market has finally broadened out. Like people have finally realized that there's more than just 7 stocks in the stock market, and that there's another 493 in the S&P, and there's another 2,000 in the Russell, and there's a lot of other mid-cap names as well that investors can invest in, and that the world does not revolve around 7 stocks and their businesses, that they're reliant on the rest of the economy. So that's actually been a positive. But even within that, yes, like I mentioned, Foot Locker down 20%. But then there are other retailers that have executed, like Urban Outfitters last week. You have Walmart that executed, but Target did not. So you can get caught up in, yes, the let's buy everything, but I do think that there's opportunities for those that do their fundamental homework to sort of differentiate the winners and losers in this current economic state that we're in.
Yeah, which I know from reading your notes that you do, because I love the sort of detail that you put in about the different companies, because you don't see that, because all we're doing is reading the headline of where the NASDAQ is, so you really do have to sort of start to dig in, I think, on those conference calls especially. This sort of two-lane highway, bifurcated economy, however you want to refer to it, makes it pretty difficult for the Fed.
It makes it really complicated for the Fed, particularly with the Fed Beige Book. So the Fed Beige Book in the last one we saw weeks ago, out of 12 districts, 10 saw no growth.
Mm.
So that's not a 2.5 to 3% economy when you read that. So the Fed on one hand is reading that because their Fed districts are feeding them that information. But then we look at other parts of the economy, and then we look at markets. Markets are partying on. What is the message the market is sending us? Is the stock market or the credit markets a tell on what investors think about the coming 6 to 12 months? Because if the markets are right, the Fed should not be cutting interest rates, and if anything, they should be hiking again. If the markets are wrong and they're just partying on because the Fed is cutting in response to soft data, well, we have a bubble on our hands in equity and credit markets. There's going to have to be some sort of reconciliation here with the Fed cutting into what they think is restrictiveness on the economy, but clearly no restrictiveness when it comes to markets, because the markets are anticipating their rate cuts. And also, if the equity markets are right and the economy is going to do great next year, well, then inflation is going to flare up again, and while the Fed's cutting interest rates. So this is an interesting dynamic here that people should be thinking about as we look to next year.
Yeah, and it's difficult, isn't it? Because I think traditionally you would look at that equity performance and be able to glean something about people's sentiment. But, I've had so many conversations where people are thinking that some people think the market is outright broken, Mike Green being one of them, that just passive flows. It's just like a robo buy, and that it's not telling you anything and creating a really dangerous environment. But other people at least think, do we have, is sort of the AI revolution maybe masking what some underlying weakness? Now, we have seen the Russell take off ever since Trump got in office, but is all of that, can it turn on a dime, I guess? Do you feel like that the stock market as an indicator is what it was before, or do you also sense that like maybe there's some false or some noise in here that's hard to sort out? How are you feeling about that?
So it is a great question, because we grew up, whether it was in college learning about finance or early on in the markets, that stock market was a discounting mechanism, right? It sort of anticipated what was going to happen, what they thought was going to happen in the coming 6 months. But to me, ever since the Fed entrenched themselves so much in markets with easy money, that I thought that the stock market was much less of a discounting mechanism and really just traded on the flow of credit and the level of interest rates, and really just focused on what was staring them right in the face. And therefore, like when I look at the markets today and I say, okay, what message is it sending me? Is it sending me that earnings growth is going to accelerate the next 6 months? Well, I don't know. I haven't seen no rise in earnings expectations for the next couple of quarters or next year. This has all been multiple expansion. Well, then why is the multiple expanding? Well, the multiple is likely expanding because, yes, optimism about Trump policy and no increase in taxes, regulatory relief, but also because the Fed is cutting interest rates. So can we sustain the equity market rally solely on multiple expansion? And just to put some context around this, the S&P right now is now approaching 23 times forward 12-month earnings, so 25 calendar earnings are nearing 23 times. March 2000, at the tech mania bubble peak, we were trading 24 and a half times. So we're getting into rarefied air. Now, that doesn't mean it can't continue on. That doesn't mean it can't exceed that. Who knows when valuations matter? But you're getting to a point where if you've been valuation agnostic, that has worked really well. I wonder how much longer that is going to work, particularly if interest rates stay elevated. Even while the Fed's cutting short rates, we've obviously seen a rise in long rates. Maybe the markets and inflation staying around 3, and the labor market hanging in there, and the economy hanging in there, and maybe the Fed just doesn't cut as much as the market anticipates. And then we have a multiple sort of re-rate because rates are staying higher for a while, and maybe they go even higher. The 10-year goes back to 5%. I don't know. Can we sustain a 23 multiple with a 5% 10-year? I think that would be tough to do, but market doesn't care. It's hoping we get some good policies next year. But the thing that is beginning to, via conversations I'm having with people in the know, is I think there's too much complacency and nonchalance on the tariff side. I think there's the belief that the tariffs will be more of a threat, not really utilized, and just a negotiating tool. But one of the things that I'm now beginning to realize is in order for the Trump administration to extend, and I know I'm sort of going off on a tangent,
Go.
but in order to extend the expiring tax cuts next year, you need like $4 trillion over a 10-year time frame of pay-fors. And it seems from what I'm hearing, we'll have to see what comes out, that the administration and the tariff hawks are looking to get pay-fors via tariffs. And that means that, are we going to see a tariff because we want to protect certain U.S. industries, like steel and aluminum, like Trump did previously? Or are we putting on tariffs because we want to encourage business to reshore and manufacture in the U.S.? Are we putting on tariffs because we want to, punish Canada and Mexico for the border and fentanyl and whatever? And or are we putting on tariffs because they need to raise the money tax-wise for those pay-fors? If it's the latter and we're just slapping tariffs on because we're trying to raise money, that's not a good thing. The market is not priced for that scenario at all. Right now, it seems to be priced at, okay, yeah, we'll get some tariffs, but it won't be a big deal, and we'll move on. But I'm beginning to become more worried that in search of these pay-fors, they're going to really go at it with these tariffs just for the sake of raising money, rather than having any strategic value to it. And I don't think that's going to go over well, but no one's talking about that possible scenario. But they do need to come up with, $4 trillion over 10 years, called $400 billion of pay-fors that they're trying to search for. And I'm afraid if they rely on tariffs, market's not going to like that.
Peter, this is such an important point, and you're right. It's one that really is just starting to peek its head out, I think. So fantastic that you brought it up. I just spoke to Juliette Declercq yesterday. We're going to release that on Sunday, folks. And this is exactly one of the things that she's looking at and she's thought about a lot. And she completely agrees that this is a really, really underappreciated risk. And when we say it's not good, listen, medium to long term, 10 years out, this may be, and she has some really interesting thoughts about this. This may be great. This may be a way to rebuild a lot of things. This may be delivering on a promise, but there is a lot of short-term pain if you're going to do that. People don't reshore in a hot second, right? So there is that sort of short-term mess that you have to get through in order to get to something if you have the political will to follow it through. This idea that is what the tariffs are really about is absolutely something that more people should be paying attention to. Absolutely not priced into the market. So I think it's super important that you bring that up. There seems to be a lot of things. I started off by saying, is it time to exit stocks? Listen, very few people are going to do that completely, right? So some people are going to have exposure. But I've been hearing a lot of people, a lot of the guests that we've had on the show get really concerned about where we are and the fact that there seems to be complacency about a lot of things. Let's throw in geopolitics, right? We have a French government in crisis, collapsing. We have South Korea putting martial law on and then rolling it back. There are a lot of things going on around the world. There's a lot going on with oil and oil prices in Saudi Arabia. The market doesn't seem to be paying attention to any of that. Now, I know geopolitics doesn't always move the needle, but does it feel like that there is a sort of huge degree of complacency about everything right now?
I'll try to quantify that level of complacency. If we looked at this was for November, so this came out a few weeks ago, the Conference Board Consumer Confidence Index, where this survey goes back to, I think, the 1970s, but beginning in 1987, they started asking respondents, what percent do you think the stock market's going to be higher in the coming year? And there was a percentage number around that. Well, the November number this year, since that question was first asked, hit an all-time record high. Now, it hit a high in October and then accelerated even further, like a straight line up in November. So, you're talking about a question being asked going back to 1987, 37 years ago. So that's one level of, okay, people are basically all in. If you look at the percentage of household assets in the stock market at record highs, if you look at the weekly city panic euphoria index, it's literally off the charts euphoric. And at 0.58, 0.41 is the threshold where you go into euphoria. So we're well above that threshold where Citi claims that that's statistically significant, that there's, according to their work, when it gets above that 0.41, there is an 80% chance that a year from now, the stock market will be lower than it is today. And then I'll throw in the investors' intelligence number, which comes out every Wednesday. From my many years of watching this, whenever the bull bear spread gets above 40, I consider that extreme. And right now it's about 44 with bulls around 61-ish and bears around 17-ish. So that's very stretched. Then you have another index where it's a National Association of Investment Managers that measures the extent at which they're long or short, usually above 100. That implies they're taking on leverage long, and we're just shy of 100. So we're very extended there as well. And then look at the stock market. We're up, I think, 11 out of 12 days in a row. And we've had, like I said, a party going on since Trump was elected. So the bull boat and the sentiment and the exuberance is very much on one side. Now, it can stay that way through the year end, whatever. But I just think that people should just be aware of their investing surroundings. If you have more of a short-term time horizon on markets, you should have one foot out the door. Now, if you're a longer-term investor, you don't necessarily have to focus as much on these short-term things that I'm talking about. But I think, again, everyone should be focused on the investing surroundings that they're in right now. Note that it's gotten very frothy.
Yeah. What do you consider long term? Or maybe that's a question everyone should ask themselves, because I saw some statistic where everybody thinks they're a long-term investor, but then if you say, like, can you afford to ride it out for X amount? It turns out we're all a little bit shorter term than we think, because we're used to things going down if there's a correction and then going back up. There's a period in the 80s where we went sideways. We went nowhere. So if we have a drawdown, is it necessarily a given that we bounce back up? What is a long-term time horizon?
Well, it's a great question. I mean, you think, we're used to V bottoms here because the Fed rides to the rescue, they slash interest rates, and after the bear market, we had this very sharp snapback. But yeah, basically what you're asking is, what happens if we become Japan and it takes, 30 something years to get back to a previous peak? It's hard for any of us to imagine because usually we snap back. But even in the U.S. markets, there are long stretches of time where you just sort of chop around, and active management does better than passive. I mean, the Dow hit a peak in 1929, and not including dividends, didn't get back to that absolute nominal peak until 1954. We peaked in 1966. We didn't get back to that level until 1981. We peaked in 2000. We didn't get back to that level until 2013. That's what happens when you have these heady returns, where we're about to have our second year in a row of 25% returns, which is extraordinary in the multiples that I talked about. Yeah, you're pulling forward a lot of future returns. And therefore, investors, while, like I said, have been very valuation agnostic, maybe it's time to start paying attention to valuations, search for cheaper areas of the market, and also look outside of the US, which has sucked up, all the oxygen from the global room in terms of everyone loving the US and not caring about any other market around the world. Maybe one should be a contrarian and look at other things other than, US stocks, which have done great. They may continue to, but you're really stretching the rubber band here.
Yeah. I always, whenever I have that internal conversation, I certainly always think, is it just that, doom porn? Like, is it everyone just being overly bearish? Are we stuck in the past? Is everything much more financialized now? Is the stock market too big to fail? Which, by the way, I think it probably is. And, the US has a lot going for it, especially when you think about technology and the AI revolution. So there are all these arguments to be all in, but there's this nagging voice that we think like 2 or 3 years and we'll bounce back. And I think if you're thinking long term, you need to at least entertain, can I have a decade where I don't need my money? It's
Yeah, that's
more
exactly
than
right.
that.
Yeah.
And that's the real risk test to give yourself when you're talking long term.
Absolutely. Now, the case of sort of U.S. exceptionalism is what you're basically saying is,
Hmm.
yeah, that's always been the case, and it always hopefully will be the case. But that doesn't mean that you go through the pendulum swings too much in one mania type, euphoric type direction, and you just have a natural move, mean reversion in the other way. I mean, expansions follow recessions, recessions follow expansions. Even in this exceptionalism, you still have mood swings, both economic mood swings and market mood swings. But yes, to your point, with the highest allocation of household assets to equities, can we afford, can we, being the US economy, US household, afford another bear market? I mean, people have short memories. They forget that the stock market fell 50% twice within a 9 year time frame in the 2000s. And an investor, particularly an older investor, someone who's 75, 80 years old, who has high exposure to the equity market, what happens if the stock market falls 50% again and doesn't rebound like it did the previous couple of times? Maybe it doesn't rebound as much because the Fed is less able to slash interest rates because inflation is remaining sticky, and that they can't really do QE because inflation's at 4 instead of 1 or 2, and we don't bounce back. If that is something that will damage your retirement or certainly hurt your lifestyle, then maybe you do have too much in stocks. And I do think that, yes, we all hope that markets usually go up, but you should still always be watching your back. You should still have a risk management type perspective, and you shouldn't never get too over your skis, particularly in your later years.
Yeah, totally. And I'm thinking, even if you're further down the age bracket and you think you're no one wants to see that kind of drawdown, which it's just so. And you're right, for anyone who went through it. And I know we used to talk about people who were older who suffered through the dot-com bust. It scarred a generation. I mean, those people didn't come back into stocks for so long because it was so painful and really damaging. There's even more complications now. So I always think it's good to ask that. I want to ask you about Europe because you just mentioned, everyone brings that up, right? It's so much cheaper. Everyone's been so in on US assets. What about Europe? I mean, the question is, right, is it value or a value trap? That's what I'm hearing everyone ask. And we have, as I mentioned, the French government facing a no confidence vote. I hear a lot of people questioning whether it's bigger than just France, and that there's not a lot of, I just saw a research note, I think from Ed Yardeni, cracks in the EU foundation. I mean, I've had people say that they don't think the EU makes it through this. They have all the problems of developed markets. They have aging populations, huge debt. There are a lot of strains. Is that, I mean, just because something's cheap, does it mean that it's investable? I mean, or do you have to really be active when you're looking at it? How are
You
you
really
thinking
have
about
to be active, and Germany, their economy has got major challenges right now also. It's very important when it comes to investing in Europe right now is to be active in the sense that the domestic economies of Germany and France, and we'll start there with them being the two biggest, there's no growth. And if anything, Germany's economy is slightly contracting. Whether it is an auto sector that just is having more difficulty competing, whether it's high energy prices, whether it's, particularly with Germany with shutting out off their nuclear plants,
it?
whether it's just this sclerotic welfare state that does not lead to natural economic growth. Then on the flip side, you have tourism that's helping Greece and Italy and Spain. But I think in the aggregate, very little growth. If you're going to invest in Europe, make sure you're investing in companies that are big multinationals, just like they're multinationals in the US. I have no interest in really buying a domestic European bank that probably has little loan growth and is just more of a utility in a sense. And maybe you can get a decent yield, but there's no growth there. I'd be more interested in investing in, again, like I said, the multinationals that can benefit from global growth. And just because they're domiciled in Europe doesn't mean they're really any different than a US multinational, but they happen to be cheaper because of where they're domiciled. Is domiciled in Paris, but they're selling goods all around the world. And their business is going to be particularly subject to the spending of the Chinese consumer, more so than just being trading on the CAC, for example. but you could get it maybe because it's trading there, a cheaper valuation. I mean, we own some European stocks that are multinationals, but are very discounted. Take even in the UK, the big oil companies that which we own, like BP and Shell, they're trading at a fraction of the multiple that Exxon and Chevron are trading on, just because they're domiciled there instead of here. Now, whether that valuation gap can close, I don't know. I'm betting that it will to an extent, not fully, but there are opportunities to invest in Europe, but keeping these things in mind. Graphically and economically, outside of the U.S., and something I've said to you many times before, I'm much more bullish on Asia, much more bullish on the growing middle class story. And even in China, and certainly in India, and Indonesia, and Thailand, and Malaysia, and the Philippines, and Vietnam, there's a very exciting story when looking out over a longer term time frame there.
Yeah, and it's harder sometimes. Not people, it doesn't come to mind right away because you have to do a little bit more homework with that. Is there currency risk with that? We know the
No
dollar's
doubt.
been strong.
Yeah, no doubt there is, and that's always the case though. For someone who invests internationally, you always have to accept that risk. The dollar rally really started to take off when Trump was elected, and I don't necessarily think so much because he won. I think it's more pricing in the tariffs that we're going to see because theoretically, the tariffing country sees a stronger currency because if the tariffs lower your trade deficit, that's positive for your currency. But even within that dollar rally, it's really been mostly against the euro because of the challenges that Europe's facing, and the ECB keeps cutting interest rates, and they will again next week. It's bounced not as much against the pound, and the yen's actually had a nice rally here because there's expectations that the BOJ may raise interest rates in a few weeks. So we'll see how that plays out. International investing does come with currency risk for sure, but that's something that you have to accept. But the dollar doesn't always go up. I mean, if it just trades sideways for a while, which it really has when you look back since the bottom in 2021 in the dollar, and it rallied, it's still below its 2022 peak, even with this
Yeah.
rally.
And there's some folks out there who do great work on currencies. Our friend Brent Donnelly is one of them. Del Pinkert, who's on Trading Coach, does also follows the dollar really closely. So there are some resources that you can get if you want to get some international exposure. Peter, just as we close out, I just wanted to do that with a word about Art Cashin, the 83-year-old director of floor operations for UBS, passed away yesterday. He was a larger than life figure down on the floor of the New York Stock Exchange. I mean, a real legend. And I know he was a good friend to you as well.
He was a good friend. I known him for a long time, probably 20 years, and had a lot of drinks with him, a lot of dinners with him. The story that I love to tell is Art never used credit cards. He always brought cash to dinner, and he always wanted an early dinner, but always left early as well before dinner ended. So what he would do is he would give me, depending on where we went and what dinner was, either $100 bill or two $100 bills, and I would pay his portion of it, and I would put the change back into my wallet. And then the next time I would see him, the next dinner, I would say, okay, Art, from last dinner, you have $50 left. Here it is. We can allocate that to this dinner. And then he'd throw me another 100 new crisp bill. And then this would go on and on. Now, unfortunately, the last time I had dinner with him, and I can't remember, that was probably pre-COVID. He had emptied, so to speak, the bank account, the wallet. I guess he had settled up, and unfortunately didn't get to see him since. But we did speak through email, and we're constantly in touch. So I know he was not doing well over the past year, but he was not only just obviously a legendary figure in terms of his tenure and length of stay on, but he was just a good person. He was a good-hearted person. Wall Street was filled with these pretentious, arrogant know-it-alls, and he was just the exact opposite of that, which was very
Yeah,
refreshing.
it was. And I know he
After I
was a
worked for
mentor.
some of those pretentious know-it-alls.
Yeah, that's right. And I know he was a mentor to so many people and a walking encyclopedia. I mean, he
Yes.
saw history,
He
like
had the
he saw
greatest
it
stories
all.
ever, and his mind remembered every.
Yeah. He was always really strict about when people would come on the floor with jeans. He was a standard bearer, he was like he held everyone to a much higher level. So
Yes,
I know a lot of people are thinking about him and remembering him. And there's that great saying, a life well lived. And I think that really
he had it.
sums up Art Cash. And so just wanted to give a shout out to him. Peter, it's great to catch up with you. Thank you so much. Really good stuff. And I just want to underline that really important thing about tariffs. I think we're going to really start hearing more and more conversation about that, and just another risk we have to keep on the radar.
Thank you,
We'll catch
Maggie.
up with you soon, Peter. Thanks
Yep,
so
sounds
much.
good. Good to see you.